Good day everyone, and thanks very much for joining this video presentation on government grants. I'm David Warneke and I'm responsible for the technical side of the tax practice at BDO. This is part two of a two-part series on government grants. In the first part, Grant Whittaker presented on the availability of government grants and the accessibility of the government grants. And in this part of the presentation, I'm going to focus on Section 12P and the income tax part of getting a government grant. The previous tax position that applied before Section 12P was introduced into the Act together with the 11th schedule to the Act was a very uncertain one. We had various exemptions that specifically exempted a number of government grants, but not all of them. So the question then remained as to what the tax treatment was regarding the other type of government grants that weren't specifically exempted. And we also had an anti-double dipping rule in the form of Section 23N, which only applied to certain of the government grants, which then left open the question as to whether one could double dip in respect of the other types of grants that weren't specifically covered in Section 23N. Now, a lot of the uncertainty has been taken away with the introduction of Section 12P in the 11th schedule. However, the position now is less favorable for the taxpayer in a sense because it has made it clear that one can't, for instance, double dip, and that one does have to reduce the base cost of assets that were funded by a grant or trading stock, as well as capital allowances having to be reduced by the amount of any government grants. And so government grants will have, in many cases, an income tax consequence, although they might be exempt on receipt or accrual. So, looking at the new position that we've got in the Act, it first of all applies for years of assessment commencing on or after 1 January 2013. So years of assessment depending on the income tax year of the taxpayer, years of assessment commencing on or after 1 January 2013. Section 12P that we're going to unpack in more detail shortly governs the exemption of the government grant when read together with the 11th schedule that lists the government grants that are exempt from tax. And it also serves the purpose of limiting expenditure for purposes of deductions, allowances, as well as limiting the base cost to the extent that there was funding by way of an exempt grant. We also have got sections 840 and P, which are recoupment provisions, 840 applying in respect of a grant that was given to fund trading stock, and 84P in respect of a grant for an allowance asset, that basically say that if one receives an exempt grant and the amount of the grant is in excess of the expenditure that the taxpayer incurs on trading stock or allowance assets, that one has to recoup the difference. In other words, if you get a grant, let's say of 100, but you only end up spending 80 on the asset, then the extra 20 has got to be recouped. The Taxation Laws Amendment Bill of 2013 proposed the deletions of both of those provisions, 840 and P, because it's believed that they are obsolete. So unpacking Section 12 capital P in more detail, 12P1 has got various definitions, and it defines government grant as being a grant in aid, subsidy or contribution by the South African government in the national or provincial sphere. And examples would be grants from the DTI, from the Department of Science and Technology, Department of Transport, or Department of Energy. Then 12P2 exempts a grant from income tax if the grant is one of the ones listed in the 11th schedule, or if it's listed by the minister in the Government Gazette as being exempt. And the idea behind that particular provision was that in between legislative cycles, it would be possible for the minister to identify grants that were intended to be exempt. 12P3 forces a reduction of the Section 11A deduction if you get a grant which is specifically to finance trading stock, as well as the Section 22.1 closing stock add back or 22.2 opening stock amount. And also, base cost expenditure on allowance assets has got to be reduced to the extent that an exempt grant was received or accrued to the taxpayer. 12P4 states that capital allowances can't exceed the cost of the asset less the amount of an exempt grant received or accrued to finance the asset. And one of the unanswered questions is whether this provision applies prospectively. In other words, if you've already claimed too much by way of an allowance on an allowance asset, if one's got to go back and readjust one's claim in an earlier year of assessment, we don't think that it applies like that. We think that it only applies prospectively, and that's the interpretation that we are going to follow in the example that we're going to have a look at later on. 12P5 states that where an exempt grant is received or accrues to finance an asset other than trading stock or an allowance asset, then the base cost of the asset has got to be reduced by the amount of the grant. So, for instance, that would apply if a taxpayer got a grant to finance, for instance, vacant land, and there was no capital allowance that could be claimed, then the base cost of the asset has got to be reduced. 12P6 states that where an exempt grant is received or accrues, and subsections 3, 4, and 5 above do not apply, then general Section 11 deductions claimed in the year of receipt or accrual of the grant have got to be reduced by the amount of the grant. So just looking at what that could cover, where subsections 3, 4, and 5 above don't apply, well, subsection 3 dealt with trading stock. It dealt with allowance assets. It applied, and then 12P4 also dealt with allowance assets, and 12P5 dealt with other types of assets other than trading stock or allowance assets. So we're dealing with expenditure but not in respect of an asset. So that could be, for instance, a grant that is received to finance general operating expenditure, or for instance a grant to cover marketing expenditure incurred. And what happens then is that one's got to reduce general Section 11 deductions, so not specific deductions that relate to the grant necessarily, but general Section 11 deductions which could be claimed by the taxpayer have got to be reduced in the year of receipt or accrual of the grant. And then if you land up with a remaining excess, in other words, if the amount of the grant was in excess of the Section 11 deductions that one was claiming, then one's got to carry forward that excess and reduce the Section 11 deductions in the following year of assessment. And what I thought we'd do is just go through an example to hopefully clarify some of the principles that are involved in the application of Section 12P. So the example is of a taxpayer, we've called it X Limited, whose year of assessment ends on the 31st of December. And let's say we're talking about the year ended 31st of December 2013. On the 1st of March 2013, X purchased a new manufacturing asset costing 10 million. Because it's a new manufacturing asset, it's subject to 12C write-off over 4 years, with 40% in the first year and 20% in the subsequent 3 years. On the 1st of July 2013, it received an exempt grant of 8 million rand to finance the asset. On the 30th of September 2013, they received a different grant, this time 2 million rand, to finance the purchase of trading stock. And then later on in the year, they went and purchased the trading stock for 3 million rand, in respect of which the grant was payable. And then let's say that in the following year of assessment, ending 31st of December 2014, they sell the asset, capital asset for 9 million rand, and the trading stock is sold for 5 million rand. So the result then would be, in the first year of assessment, our 12C allowance would normally be 40% of our expenditure, which was 10 million rand, which is 4 million rand. But in terms of Section 12P, we've got to limit it to our expenditure of 10 million rand, reduced by the amount of the exempt grant of 8 million rand received or accrued. So we've only got 2 million rand left to write off. So it's 4 million limited to 2 million, and then we write off or claim 2 million under Section 12C. The base cost of the asset also has to be reduced by the amount of the exempt government grant. So our expenditure was 10 million rand to begin with. We reduce it by the 8 million of grant. And just remember that base cost is on an ongoing basis reduced by the amount of any claimable allowances or deductions in respect of the asset. So we've got to reduce it by, in terms of Section 23 of the paragraph 23, I beg your pardon, we've got to reduce it by the 2 million of allowances claimed, so that at the end of the first year, the base cost of that asset is in fact zero. In respect of our trading stock, we spent 3 million rand on buying the trading stock, but we were funded to the tune of 2 million rand by an exempt government grant. So Section 12P says that we've got to reduce our expenditure for purposes of Section 11A and the closing and opening stock amounts by the amount of the exempt grant. So we've only got 1 million rand to claim. The idea being, generally speaking, that one should only be able to claim on amounts that you're funding out of your own pocket, as it were. So in the case of the capital asset that we looked at, we received an 8 million rand grant, which was exempt. We paid 10 million for the asset, so we were only in effect paying 2 million out of our own pocket, and that's the limit of the allowances that we can then claim, and as well as the base cost. So our closing stock add back is 1 million rand at the end of that first year of assessment. In the following year, the year in which the assets are sold, insofar as the capital allowance, the capital asset is concerned, we've got a potential Section 12C allowance, which would normally be 20% of our expenditure of 10 million, which is 2 million rand. But it's limited to our expenditure of 10 million rand, reduced by the exempt government grant of 8 million rand, and then further reduced by any allowances that we've previously claimed under Section 12P4. So in fact it's limited to zero, and we can't claim any more than zero in year 2. Then when we sell it for 9 million, we would recoup 2 million of the allowances that we claimed. Remember that we only ended up claiming 2 million of the allowances, and that would then be the amount that we'd have to recoup. So if we look at capital gains tax, our proceeds are the 9 million that we got when we sold the asset, but reduced by any amount that's got to be included in gross income, which in this particular case is the recoupment of 2 million rand, which gives us net proceeds of 7 million rand, and the base cost has now been reduced to zero, or it was reduced to zero when we claimed our 2 million of allowances in the previous year. So we land up with a capital gain in the amount of 7 million rand. Insofar as the trading stock is concerned, we'd have an opening stock deduction of 1 million rand, which matches the closing stock add back in the previous year of assessment of 1 million. And therefore, we'd land up paying tax on 5 million of proceeds less the 1 million opening stock amount, giving us 4 million rand in summary. I changed the example to just consider what would have happened if the grant of 8 million rand in respect of the capital asset had been received or accrued in the 2014 year of assessment and not the first year of assessment. So let's say, in other words, that we went out and bought that capital asset for 10 million rand in the 2013 year of assessment, and we only ended up getting the government grant a year later, but we brought it into use immediately in the 2013 year when we bought it. So what would have happened would have been in the 2013 year of assessment, we would have claimed our 40% Section 12C allowance of 4 million rand. We don't reduce it by any exempt grant because nothing had been received or accrued at that point by the year end. So then what would have happened would have been that our section, in terms of Section 12P4, the allowances available in subsequent years would have been limited to nil. Because in terms of 12P4, one's got to limit them to the amount of the 10 million rand expenditure, less any grant received, which was nothing in 2013, but subtracted by the 40% that we would have written off in 2013. So we would have had 6 million left to claim, but in the 2014 year we now receive the government grant which is exempt of 8 million rand, which has got to further reduce the amount that is available for write-off, and in fact we then land up with a negative figure in 2014 because we've got 10 million minus the 4 million that we claimed and minus the exempt grant of 8 million. And as I mentioned earlier, we're interpreting this in the way that it only applies prospectively, so we don't go back into 2013 and readjust the amount that we were able to claim. Then if the asset was sold for, let's say, 9 million rand, let's take, say, a year later in 2015, remember now that we would have claimed a total of 4 million rand in the 2013 year of assessment, and we would be recouping the 4 million rand that we had claimed. The base cost of the asset in the year that we sell it would have been 10 million rand minus the allowances claimed of 4 million. We've got to further reduce that by the amount of the exempt grant of 8 million rand, and we land up with a zero base cost in the asset. The proceeds would be 9 million rand, and we've got to take out of proceeds the amount of any gross income included in the proceeds, which is the 4 million of recoupment, which would give us net proceeds of 5 million rand, leading to a capital gain of 5 million. So I just thought this was quite interesting to compare, because if you got the government grant in the subsequent year, like we're looking at in this example here, we end up with a capital gain of 5 million rand. Remember that in the previous example we had a capital gain of 7 million rand. So we land up with a lower capital gain where we had the grant received in the later year of assessment. In both cases, what we would have done would have been to claim an initial capital allowance, and where we receive an amount in excess of that, we would then be recouping the full amount of the capital allowance. So in a sense, the capital allowance is an in and an out, and we're left with a capital gain in situation 1 that is 7 million rand, and in situation 2, 5 million rand. That concludes this presentation. Thanks very much for joining me, and I hope that you found it interesting and useful.